get things started right away here with Joe Saluzzi, partner and co-founder of Themis Trading. Joe, how you doing today?
Joel, I'm doing great. Dennis, nice to talk to you guys again.
Okay, let's get started with a little bit of your market background, how you got started, and when did you start Themis Trading?
Sal and I started Themis Trading 12 years ago, 2002. We were both Instinet guys for about 10 years, and then we decided to branch out on our own and do our own agency brokerage firm. And, what we do here, we trade for institutional clients. So our clients are hedge funds and mutual funds. And a few years back, we got into the market structure world where, we started noticing changes in the market, particularly after Reg NMS in 2007. And that led us to really dig further, write some white papers. We run a daily blog that we have, we're almost daily, a bunch of times during the week. And then we also wrote a book called Broken Markets, which pretty much detailed a lot of the market structure issues that we're still talking about today. And, we wrote our book in 2012. Michael's book, Flash Breaks, came out in 2014. And, we're still talking here.
What were those things that you noticed in the market structure there, Joe, that kind of tipped you off? Like, what was it? Your order execution issues? What really started tipping you off that made you notice that there might be issues with the market's plumbing?
Yeah, it was definitely post Reg NMS. So Reg NMS was 2007 was the implementation, and that's when we noticed the fragmentation. Particularly is the word that we always use, where where you used to have liquidity, which was much more bucketed, and maybe the spreads on certain stocks were a little bit wider, but not necessarily. But when we really think that spreads actually narrow due to decimalization in electronic trading, not due to HFT. But we noticed that the fragmentation, new venues started popping up, and there was all of a sudden there was 13 exchanges. Now there's 11. There was numerous dark pools, and you couldn't get what you thought was out there. And I think Brad Katsuyama described it in Flash Boys really well, where there's 10,000 shares on the offer, and you go to sweep it, and you get 3,800 shares. Like, where the rest go? It didn't print. I didn't get it. It canceled. How did that happen? So we started digging, and we started finding all different types of, let's just say there was order types, there was different types of routing destinations. Certain folks rely on their algorithms. A lot of institutional investors rely on an algorithm supplied either by a broker-dealer or a third party, and sometimes those algorithms go to a destination which isn't necessarily what we consider a best execution. Maybe it's going to the destination that pays them a rebate the highest, or there's a partnership there, or there's an IOI going out, or whatever it may be. And so we took control of our order flow. We decided that, we're not going to leave our flow in the hands of a smart order router at a broker's algorithm, because that's not doing our clients a service. We control our flow. We decide which destination to go to. And over the years, we've developed our own in-house technology or smarts that we think actually can compete a lot better than a lot of those algorithms. And our clients agree, I think, and that's why we're still in business 12 years later.
So what do you do there, Joe? Do you break the orders up, make them smaller? How do you avoid getting detected there?
I would say the first thing we do is we pay attention, right?
Yeah.
You really have to work still. I mean, you cannot just rely on a machine. You can't, as we kid around and we say, set it and forget it. Some folks think that you could just put it in the box, walk away, and the algo takes care of it. You cannot do that today. There are so many sharks. There are so many traps. There are so many predators. And it's up to you as the investor or the institution to take control of that, because these guys are always going to be there. And I'll complain about them, and I'll talk about what they do, and we'll try to change some of the rules. But the bottom line is I have to control that order flow to make sure my clients get a best execution. It matters. You have to pay attention. You have to know which destination you're going to, almost to the point where you're constantly fighting what you think is a predatory algo, right? And you're trying to do opposite things. We've built kind of what we call a secret sauce in here, which of course I won't get into, but we think our executions are pretty good. And then we run post-trade reports, and our clients run post-trade reports as well. And like I said, if we're still here fighting these guys 12 years later, we must be doing something right.
What you're talking about really there, Joe, is these predatory high-frequency traders. You're talking about the order sniffers, right? Like the high-frequency traders that try to go out there and detect these algorithms to buy ahead of your algorithm and then try to drive the price on you, right?
Yeah, there's no doubt that happens. Okay, that is a fact, and that's debatable. I'll debate that with anybody. And the way they do it, of course, is there's all different sorts of technology that an HFT can use. Now, first of all, and I'll say it too, is this illegal? Not that I know of, okay? Is there rules that may be violated? Well, that's what the regulators should be looking at, and whether or not they're armed to that task is a different question. But let's just say, what are they doing? If you post a bid out there okay, everybody knows that probably listening here is that, let's just say the spread is a nickel on a stock, okay, and you try to tighten up that spread, and you post 10 cent, 15 cent, 10 cent bid offered at 15, you post an 11 cent bid. What's going to happen? Most likely, a guy's going to jump to 12 cent bid. Maybe the 15 offer cancels. Another guy comes up at 13. Next thing you know, you're 15 bid offered at 20, and nothing's trading. That's just a typical activity that happens in the marketplace. But what we were more concerned about is, how the data feeds are coming in, how certain, what's in the content of a feed that an exchange supplies to, let's just say, any client. Anybody can buy a data feed, by the way, but most people don't have the technology to even process it. But if you take this data feed in and then you do what they call the collocation of your computer next to the exchanges, you're getting it faster. So they're seeing the data faster. Are they seeing it before the future? There's been a debate. Well, we can't see anything before the exchanges to send it out. Well, that's correct, but you can receive the data faster. Okay, there's a difference here. There's distribution versus consumption. The exchanges will distribute the data at the exact same time, going to the SIP, which is the Security Information Process, or going to your own, let's just say, HFT system. But the consumption of the data, when you take it in, is become much faster by the high-frequency trading guys versus, let's just say, the SIP or any other average investor. So there is a timing difference, and that's where some of the predatory games start.
So they have an edge by getting the information faster than the little guy?
Absolutely. I mean, there's no question about it. There's something called latency arbitrage, which was debated. We debated this for years, and people thought that we were crazy saying that it happened. And now post Flash Boys, it's pretty much everyone knows that that is a fact, where you can pretty much see the price first, and then you can adjust your markets. And, because they are market makers. High-frequency traders will tell you they're market makers, although they have no customers. And I'm sure, Dennis, you probably think that market makers, as I know, back in my day, market makers had customers, but nowadays they don't. They're prop traders. So they can see this information, adjust their markets, because they know when a bid is there, before the SIP shows it, before the public can see it, or before, even worse, a dark pool, which may be pricing off of the SIP. Here's a crazy thing, right? A dark pool is pricing off of stale information. So if you know the market has just changed, you can go out and send an order into a dark pool and maybe pick somebody off. That in our opinion has no business in this market. That's where the games start. Latency arb or rebate arb, where they're just trying to collect a penny or two, or a third of a penny. That has nothing to do with investing. Okay? And that's not market making. That's not stat arb. That's not ETF versus futures. That's just garbage noise in the market that needs to go.
There's a good point you're making there, Joe, with the rebate arb. We see so much of this in big stocks like Bank America, BAC, where the stocks will trade in a penny or a 2 penny range, and they go back and forth between the bid and the offer. And a lot of times you'll see, an enormous amount of liquidity in a stock like this, where these high-frequency traders are just trying to get in there and capture the rebates. It's like a whole almost subculture there on this stock. So you have an enormous amount of liquidity there. But then if you look into the small cap market and you look at, the rebates, and it's not even an issue there. And the high-frequency traders, we'll have Ezra Rappaport on later today, and he's saying how a lot of high-frequency traders don't even trade those kind of stocks, the smaller caps, because there isn't the liquidity there for them to get in and out of it. And the rebates, aren't an issue. The rebates aren't giving you. So if you're saying rebates, just for the first-time listeners there, you're talking about these access fees that are attached. So basically, if you're bidding a stock, there's a fee attached to that, where if you go to take that bid, if somebody hits you on that bid, the person that was providing that bid will actually get paid a fee. And that's what Joe's talking about with the rebates. So they do provide a lot of liquidity in these big caps with these rebates, but it doesn't help in the small caps, does it?
Well, and by the way, liquidity, let's define that. They're providing volume in those big cap stocks, right? To me, liquidity is I need to sell 10,000 shares. Is there somebody there to buy it? In a Bank of America, it's a different type of stock. Let's talk about those small caps that you're saying. Is there liquidity in the small cap sector? And we would argue it's thin at best. And most guys know that if you try to trade a decent-sized block, it's going to be tough because there's no real market makers there. There's no real buyers and sellers. And a lot of the institutional clients, they're not going to play in these stocks anymore. They don't want to take a position of, 10, 20, 30% average daily volume of a stock if they can't enter and exit without that much implicit transaction cost involved. So they end up leaving these stocks. And then what happens is what we've done is we've kind of hollowed out. We use the term hollowed out the equity markets, where everything, on the top, if you look at the crust, it's a real hard crust of Bank of America, or IBM, Cisco, all these stocks that trade a lot. And then when you cut through that crust, you've got a real empty core. You've got stocks that no one's ever heard of. You've got delistings. The Wilshire 5000 actually is around 3,500 stocks, okay, which is kind of crazy, because we're losing the infrastructure. We're losing the internals of the market. The old-time market makers and specialists and folks had a problem with them, but there was a role. There was an ecosystem to the trading environment where people knew there was research, there was investment banking, there was trading departments. That's all been gutted out due to lack of economics. So what you've been left with is kind of nothing in the middle. So how do you bring back some of the real liquidity? How do you bring back the research to these small-cap companies so that the larger institutions can see them and say, hey, you know what, I really want to invest in that, and I feel comfortable that I can enter and exit it. It's certainly not going to be by high-frequency trading, and as you mentioned, Dennis, they're not there, and we know they're not there except for some predatory guys who hang around just looking to pick you off every once in a while. So how do you bring it back? We do think that the SEC actually made a very good proposal with what they call a tick size pilot program. We can get into that later if you'd like, but there are some good ideas out there that people are now coming around to kind of say, hey, you know what, we got to build this back up.
Do you think the tick size pilot helps? We're going to talk about this with Larry Tabb a little bit later on too, the tick size pilot, so we will dive into the details. But the tick size is just basically a pilot program that's been proposed here now by the SEC, where they're going to actually widen the tick on 1,200 different stocks to a nickel from the minimum price variance from where it is just a penny. And I think the hopes for that is that if you have a little bit wider spread, maybe there's more incentive for market makers to come in there, because when they're only able to make a penny, then you can make a nickel. It's a little bit more incentive. But the problem is a lot of these small caps have spreads a lot wider than a nickel already. So do you think it really helps?
Well, yeah, that's the exact point you just made there, Dennis. It's the tick that's widening, not necessarily the spread. And I do think it helps. I do think it's going to be a very good pilot, unless they end up screwing it up before it's even implemented. And there are some concerns about the plan that's being developed already. But let's think about it. They're not widening the spread. This is what the people who are against the pilot program are going to say. Well, hey, listen, Mr. Retail Investor, the SEC is going to widen the spread and your costs are going to go up. That's incorrect. Absolutely incorrect. They are widening the increment of the stock price to a nickel, which means that you may have a small cap stock right now that actually has a 30-cent spread. That stock may in fact have a smaller spread when you do implement the tick size program. It may go down to a nickel, but the fact of the program is you can't quote by a nickel. You can't penny jump. Okay, that's the bottom line. So in other words, the tick size pilot is trying to disincentivize the guys who are just jumping in for a penny, trying to make a quick one. They want you, if you want to go in there and display liquidity, it's going to cost you to jump somebody up. So the theory is we will now bucket that liquidity more. We will now find more levels. Okay, at 10 cents, there'll be more than just 100 shares. At 15 cents, there may be more than that. So then maybe all of a sudden an institution says, you know what, I can get involved in this stock because there's something there. I don't mind paying the crossing the spread for a nickel as long as I can get some execution done. And that's where the theory is the market makers will come back and say, you know what, there are some economics to a spread. I can commit some capital here. This may work. And then in conjunction with my research and investment banking departments, guess what? We bring back the ecosystem. That's the hope. But what the pilot program is designed to do is to measure this. Let's take a look. If it doesn't work, okay, well, then maybe we're wrong. But that's why we think the SEC did a great job by saying, hey, let's make it a pilot. We think it should be longer than a year. They have it for a year. We think it's going to take time for folks to adjust to it. But we do think it is a good idea, and we're hoping that it does work.
The one concern there, and I totally agree with you on the penny jumping, Joe. I see it every day. I've been trading these markets for 16 years, and I used to trade the small caps a lot of times, and I would tighten those spreads. I tighten them back in the day. But if I put up, like you said, if the stock's got a 30-cent spread and I go a penny above just to tighten the spread to 29 cents, right away there's a penny jumping algorithm that jumps ahead of me. And then I go up another penny, and they'll go up another penny. So you're just battling with this penny jumper, and you can't be on top. The algorithmic penny jumper will not let you be at the top of the queue unless you go way up there, and then they smack you. So you just can't win. But so I agree that'll help with the penny jumping. My concern is this quote matching stuff too, though, because if, for instance, you're bidding on ARCA, a lot of times you'll see the print go on INET, or you can get into the whole internalization argument where they're just able to match your quote too. Is that a concern there for this, Joe? Do you think we need to maybe address, a little bit more of the internalization aspect, and will the trade at rule potentially help that?
Yes, actually, in the tick pilot program, there's 3 test buckets, okay? And one of the buckets is with the Trade Act component, which I think the industry was very upset about because they're deathly afraid of a Trade Act component, which basically means that you have to trade that lit liquidity, that's visible liquidity on the exchange, before you can trade anything off exchange, whether it's a dark pool or an internalization, a market maker. That to us is a real good idea. If you really want to build liquidity and encourage lit liquidity, well, then you can't let someone just say, hey, I'm going to trade. Okay, you quote the stock, Dennis, and I'm going to trade it around you in the dark. Well, you were the one who just took the risk, and you get no reward for it. So we do think there are 3 buckets. The third bucket is that Trade Act one, except that now they're trying to put all these different exemptions and exceptions to it, but hopefully they don't neutralize it too much. But that's the one where you'll really start to see some real activity, I think, as opposed to if I can just jump you for a penny in the dark. Well, that doesn't make any sense. What good did that do? I didn't do anything in the tick size. I just made it worse, probably. So we'll see. There are 3 test buckets. It's going to take some time to analyze that stuff as well. Hopefully, the SEC has all the the data they need from the exchanges. But we'll see. I do think a Trade Act will help that.
Joe, to finish things up here, we got to get your thoughts on Michael Lewis' book, Flash Boys. Strong words. The markets are rigged. Are they really rigged?
Well, we wrote a book called Broken Market, so I guess I agree.
Which is up on the screen right now, which we're showing live. So I guess
broken, rigged. Look, Michael's point on rigged. He didn't want to say I think he said this in public. He doesn't mean rigged like you can't analyze a company for fundamental valuation and make money in the long term. That's not what he's talking. He's talking about the rigged of the latency arb that we just spoke about, the rigged of the rebate. So the smart order router going to its buddy at the dark pool who's sending an IOI to another guy. These are the internal market structure components that are rigged that need to be fixed. He didn't say rigged that you can't make money in the U.S. equity markets. Now, of course, the other side of the argument took that and they ran with it saying, oh, look, Michael Lewis is wrong and this is not rigged. Absolutely not. That's not what he was talking about. His book actually put market structure back on the map. I mean, it's a tough fight. I mean, we do it every day. It's really difficult material to get out there and disseminate. Most folks, when you start talking about market structure, they glaze over. Like, what are you talking about? Smart order router? I don't care. But Michael brought it to the mainstream, so his book was fantastic.
Great.
And we thought that everything in there, people may argue and pick away at certain footnotes. He was right, okay? And that's brought the argument to the SEC, the AG. Everyone's involved. There's all sorts of, now they're in class action lawsuits, but it's now at the forefront and everyone's talking about it, so it was definitely a success.
Okay, we're going to get a little different perspective on this. We're going to take a quick break and bring on Larry Tabb, founder and CEO of the Tabb Group.